Have you ever looked at a company's financial reports or tried your hand at fundamental analysis and felt overwhelmed by the terms like EPS? Or wondered how investors use it to gauge a stock's profitability? By the end of this video, you'll not only understand what EPS is, earnings per share is, but also how it can help you make smarter investment decisions. Let's simplify this crucial metric and show you how it fits into the bigger picture of investing success. Hi, my name is Noah Davidson, and I am a passionate investor and financial educator. And I'm here to help make stock market concepts like earnings per share simple and actionable for you. In this video, we'll cover what earnings per share is and why it matters, how to calculate earnings per share, what qualifies as a good or a healthy earnings per share when analyzing a stock, some of the common pitfalls to avoid when using earnings per share to help you select stocks, and real-world applications of earnings per share in stocks fundamental analysis. So let's jump right in. What is EPS and what is it used for? EPS stands for earnings per share. In simple terms, it is the portion of a company's profit allocated to each outstanding share of stock. Think of it as a way to measure how profitable a company is on a per share basis. Why does EPS matter? Investors use it to compare profitability across companies, industries, or even historical periods within the same company. It's also a key component in calculating a valuation metric like price to earnings ratio, or a PE ratio, which can help determine if a stock is overvalued or undervalued. How do we calculate earnings per share? The formula for earnings per share is straightforward. Let's break it down. Earnings per share equals net income minus preferred dividends divided by the weighted average of outstanding shares. Here's an example for you. If a company has a net income of $20 million and the preferred dividends are $2 million, and the weighted average outstanding shares is 10 million, then you could plug those numbers in and the earnings per share would be 20 million minus 2 million, which would equal 18 million, divided by the weighted average outstanding shares of 10 million, and the answer would compute to 1.8, or $1.80 in earnings per share. You might be wondering what a good or a healthy EPS is. A good or a healthy earnings per share can vary depending on the industry and growth stage of the company. Here are some tips. Compare EPS to industry peers. A higher EPS generally indicates stronger profitability, especially when compared to their peers in the same industry group. Look at historical trends. Is the company's earnings per share growing over time, or is it shrinking over time? This could signal consistent profitability and potential for growth. Consider the company's size. The examples I've given you were for very small companies. Large established companies may have higher earnings per share, while smaller companies might be focusing on growth rather than current earnings. Here's a pro tip for you. EPS alone doesn't tell the whole story. Always pair it with other metrics like revenue growth, debt levels, and the company's overall financial health. Some of the common pitfalls: while EPS is a useful fundamental metric, it has its limitations. So here are some of the common pitfalls to avoid. A common pitfall is ignoring diluted EPS. Companies often report both basic and diluted earnings per share. Diluted EPS accounts for potential shares from a stock options or convertible securities, making sure to check both figures as a more accurate view. Failure to consider share buyback programs. A company can artificially inflate its earnings per share by repurchasing shares, buying them back from the public. reducing the number of shares outstanding without actually increasing their profits. Another pitfall is the failure to consider or take into account if a company has a share buyback program. A company can artificially inflate its EPS, its earnings per share number, by repurchasing shares, buying shares back from the public, reducing the number of shares outstanding, which can make the earnings per share number appear to go up without actually increasing overall profits. Probably the biggest single pitfall I've seen investors make over the years is overemphasizing or putting too much weight on a single metric like EPS. Don't rely solely on earnings per share. A company with high EPS might have other red flags such as high debt or stagnant revenue growth or other common fundamental issues that aren't accounted for in a simple metric like earnings per share. Let's take a moment to look at how professional investors use earnings per share in real-world scenarios. A professional investor is always going to be evaluating trends. If a company's earnings per share has steadily increased over the last 5 years, it indicates a strong financial trend or strong financial health of the underlying company. Conversely, declines in earnings per share could signal trouble. A professional investor is always going to consider industry-specific metrics. In some industries, EPS or earnings per share might be less relevant. For example, startups often reinvest profits for growth, leading to lower earnings per share. But this doesn't necessarily mean they're a bad investment. Some industries operate on razor-thin margins, so earnings per share might be less impressive in industry A compared to industry B, where they have higher profit margins. Comparing like stocks in like industries will help you gauge a benchmark for what a healthy earnings per share in the industry might look like, and you might want to look for those industry leaders that are shining in all other aspects of fundamental analysis to help you determine what good, healthy fundamental metrics like earnings per share should look like for that industry, or could look like for that industry. Now that you understand EPS, earnings per share, you're one step closer to making informed investment decisions for yourself. But how do you put EPS into context with other financial metrics? That's exactly what we'll cover in our next video. If you like this video and found it helpful, hit that like button and subscribe to the channel for more investing tips and tutorials. And don't forget to hit that notification bell icon so you'll be notified when our next video comes out. And if you're ready to take your stock analysis to the next level, click on the video here and learn about price to earnings ratios. Thank you for watching, and I'll catch you in the next video.